welcome to this interview series where we bring you the minds behind managing your money. Every week, we delve into the strategies, philosophies, and the ever evolving dynamics of the financial markets through the eyes of seasoned professionals. Today, joining me and my colleague Chirag is Rohit Singhania, co-head equities at DSP Mutual Fund. Welcome, Rohit.
Thank you, team.
Could you start by telling us what initially drew you to the financial markets? So your journey started with a BCom and later an MMS in finance. Were there a specific moment or influence that sparked your interest?
If I remember right, it was always, I always knew I wanted to do BCom, right? I was not a very, very bright student. So, the science was, out of it. When I went to college, I met few friends whose parents, like fathers, was into stockbroking and, research and all. So read more about it, and somehow the interest developed. And I remember when I was in 11th end or 12th, that's when I decided I have to do my MBA in finance and try to work, something related to stocks or investment banking. Because if I remember right, that time investment banking was a high quality word. You're an investment banker. So that's why it struck me. It's a good profession to be in. And that time, lot of things were not happening, right? Equity markets had just opened up in 92, 93. We were talking about so many things. So that's what I think it came in my head that time. It could be a good profession, and touch wood, it worked out well.
Okay. Rohit, another thing was, after you did your MMS, you have worked with various organizations like HDFC Securities, IL&FS, Quantum Securities. So what were the key learnings at that point of time from those experience on the sell side?
So, Chirag, when I started my career, my first job, right? First official job. I was just a raw guy, So I was given sectors like cement, metals, and auto. And luckily, I had a good bunch of seniors, who helped me understand, what is the meaning of each sector, how what works. So learning in that phase, the first 4 years was every sector dynamics are different, right? One size doesn't fit all. Two, you doing a sector, you say I'm a jack of all trades, or I'm an ace of all trade. If you're a sector analyst, you need to understand in depth of each and every sector, the modes of every businesses and what drives the business, right? On the sell side, the one thing easy was you have to give a call. It's a buy recommendation or a sell recommendation. And then, of course, you did your hard work. You tried to analyze stocks, meet companies. But it was easy. Buy Boldia, you went wrong. You used to feel bad, but never used to pinch you so much. But coming on the other side, it is not a recommendation, right? I think my learning from the sell side was a deep understanding about sectors. Unlike in a buy side, you're not spoon-fed. Today, if a new analyst joins me in DSP, I'll give him names of 4 analysts who will call him or her, make him understand the sector. It's on the platter, right? But on being on a sell side, you have to do everything yourself, rug it out, make your own models, see how to balance it. You used to balance balance sheets, in college exams. But while you're making an annual report or a P&L, a company balance sheet, you do that also when you're on the sell side. That aspects of, bottom up, doing everything by yourself, I think that helps you till today. And today also when I'm sitting with my analyst for a model, right, I like doing it with my fingers because you're used to it. So that experience comes only from sell side.
Okay. So coming from starting as an analyst and then becoming a fund manager and at various roles at DSP Mutual Funds. So I just wanted to understand what's your basic investment framework and what kind of markets or situations really excites you.
Right. So I think the starting point for me is nothing is good, nothing is bad. If there is something good, there is something bad, there is a reason behind it, right? Today, when I analyze the company, it looks good. Why does the company look good, right? You read the balance sheet, P&L, good return ratios, good cash flows, good growth over the last 4, 5, 7 years, good management track record. You say it's good. But I'm buying the company today. So I'm buying it for the future. Can those things continue in the future? Yes or no? Whatever modes the company enjoyed in the past, can they continue? Are they changing? Are they improving or getting worse? Same way on the bad side, right? If you're analyzing a company, you feel that its cash flows nahi hai. ROEs are low. is there a reason behind it? If it's a cyclical company, the sector was in a downturn for last 3-4 years, how will the balance sheet look good today? But if you're of the view that going forward there is a cyclical turnaround, then there a delta ROE? So for me, starting point is not very binary. I'm open to analyzing everything, whether it's good or bad. Two, I don't like overpaying. By that, which I mean is margin of safety while buying a stock. Everyone analyzes a stock. Someone gives X value, someone gives X plus 5 value. I mean, that's each and everyone's prerogative. But what is the margin you're buying it today? If you go wrong, are you paying the next 5 years ka price today? Then how the price is going to appreciate, right? So for me, I would say nothing good, nothing bad to start with. It's a very open slate to look at it. And two, buying good growth companies where there's a margin of safety in valuations. I would say that is my style.
Okay, okay. And which are the markets or situations which you really like, in the scenario of markets where, you really like investing in a stock or, moving out of a stock?
I think this is a tricky question, right? Because today, as fund managers, we always like markets doing good, right? But I would say that's one part of it which is not in your hands. So what really excites me is, if you're analyzing a stock or buying a stock or positioning a portfolio in a particular manner, the thesis behind which you have bought the stock or sold a stock or reduced weight or increased weight, if you're getting that right, I think that's the kick. I mean, I'll give it in last 2-3 years, there have been instances, and I mean, without naming a stock, right? We have bought those stocks thinking, this is how the fundamentals will move, numbers will move. So this is how much the stock price should move. The fact is, stock price has moved far beyond that, but the fundamentals, what my investment argument was, वो अभी तक आया नहीं है. So then you feel, then it's not a fun thing. The fun thing is what inputs you are given while analyzing. If you get that right, of course, who doesn't like market going one way? But for fund managers like us, if market going one way, it's a difficult call from an investor's point of view, right? Their expectations go up. If you don't perform for 3 months, or if your NAV is not going up for 3 months, then you get questions that आप क्या कर रहे हो? So I would say steady state market where you have strong fundamentals playing. At times you have variances, right? I mean, some global events happen or domestic something happens, and suddenly you take advantage of it tactically, but you can't be happy with it, because then you yourself sometimes don't know what is going to be the end game for it. Right? You're assuming that. So I would say a steady state market where fundamentals play a stronger role, that excites me more.
You made an important point, giving an example of a stock where, when the stock prices have moved up sharply, but the fundamentals have not remained had not moved according to the share price. So given the current scenario in the market, specifically in the mid and the small cap segment, do you see that this is a picture across the board that the share prices has moved up and the fundamentals has not moved up?
No, Chirag, I would not say it's across the board. And I would not say it's across, even in sectors, there are one or two names like that. So it's very specific, right? So what's happening today is everyone has become a fund manager, right? Everyone thinks, "Jo main karunga, it's the right thing," because really, I mean, for last 2 years, you haven't seen a drawdown, right? So what's happening is, I mean, you hear a company today in XYZ sector, you feel okay, which is the next company? Let me look at it, and you're willing to give more benefit of doubt. Then that's what my worry is. Everything is going good. Chalo, Chirag has done historically 10% growth. Now he can do 15. Now for me is why he can do 15. That's more important, right? But the fact is I've gone wrong. I sold the stock thinking, it's gone way beyond my price. Fundamentals are not come up. The stock it's up since I sold. But that's fine. When there's no margin of safety for me, I don't mind going wrong and selling. Okay, I don't understand the price now, so I'm selling.
Okay. So in that particular scenario, you move out of the stock.
But see, when I cannot justify why I'm holding it,
Okay.
then why should I hold it?
Okay. Okay. Rohit, another thing was you spoke about the fundamentals. How do you invest, and what is the strategy? But what makes a stock compelling by the portfolio? What are the factors, or what things do you look before stock enters your portfolio?
Right. So the basic things I hope with all the fund managers look is one, your business outlook, your return ratios, cash flow generation, right? That gives you the business view. This business is good or bad or so, right? So once you have that confidence, then you come to can that business confidence continue over the next few years? The modes which I mentioned, right? Whatever I am seeing today, the reasons behind it, can it continue? Three, at what price I'm buying it? And why that is most important is I'm buying the business, yes, but I'm paying a price for it, hoping in next 2 years, 3 years, the price will go up and I'll make returns for my investors. So what price I'm buying? So over there, every sector has got its own nuances. Like for example, in financials, we look at price to book multiples. In stocks like consumer staples and IT, we look at PE. For some engineering goods, some pharma names, you look at EV EBITDA, right? So in that lens, based on its history, how is it trading at in terms of valuation, and what can be the likely scenario? Lastly, the risk associated with it. What if I go wrong? In my assumptions. So these four aspects, sometimes the risk is number one. If you think the stock is very expensive or done very well, then what are the risks for it to reverse? I would say a confluence of these four determines the stock entry or exit in the portfolio.
You've been with DSP for around 2 decades now. What has kept you loyal to one fund house, and how have you seen your career grow at DSP over the years?
I still remember when I'd come for the interview at DSP, right? So I think I knew all the fund managers at that point of time because I was in sell side. So no, they knew my work and it was easy. So I met my HR for the first time. So he saw my CV and he said, last 4 years you have changed 4 jobs, right? So how should we? I believe I said maybe I was not working in the right organization. I think one, the organization plays an important role, and two, what kind of work you're doing or what kind of opportunities you get. So, I joined in 2005. I was part of the PMS team, right? So we had those PMS accounts and advisory. Gradually, when we decided to shut it down, our team on the mutual fund side, they thought, Vineet, both that time Vineet was also with me. These two guys, we can induct them into the mutual fund side, being good talents. So again, that thought, the people in the organization, not only in your team, but across the team, they appreciate your work and they're giving you an opportunity. Today, not today, when it was even an analyst level, when you speak to, maybe your HR, your fund accounting team, your marketing, the way they react, behave. So it's a culture, I think, that keeps you. And two, opportunities, right? It's not that only the culture will keep me at one place. So we have got opportunities at every point of time where you thought, you need to develop and grow. I would put it to that. So if you put it last 24 years, this is my fifth five. I've changed 5 jobs, 4 jobs, but last 20 years, no job change. I would put it that way.
Moving on to the next question, Rohit. Looking at the portfolios of DSP ELSS Tax Saver and DSP Equity Opportunities Fund, the top holdings are heavily weighted towards the financial sector. What makes you so bullish on financials?
Yeah. So when I look at financials, right, and I mentioned that 4 aspects of how do I look at analyzing stocks and sectors. I think business outlook, I think the credit growth, I think we are on the cusp of it. We have seen a lot of expansions, a lot of spends from the government. I feel private sector will come back. Two, balance sheets. And if you go back in the period 2017, 18, 19, none of these banks could, lend. They had their own capital issues, inadequate capital, a lot of NPAs. Today, when you look at balance sheets of any bank you pick up, I mean, the balance sheet couldn't get better, right? So today, when my analyst says, "Sir, I expect improvement in balance sheet," I say, "No, don't expect improvement. Expect steady state if you want to be more bullish, right?" So third, valuations. I think banking is the only space today in the entire number of sectors listed where valuations give me that 100% confidence. You're not overpaying for that particular price. Fourth part, which is the risk, as I mentioned, yes, you may have a risk of temporary credit growth slowdown, NIM being slightly lower, but that's already there in the price. So all these 4 aspects, they fit in well, and that is why you're seeing both the funds having a significant overweight on the banking space.
Rohit, if we come to the DSP Dynamic Asset Allocation Fund Management only 6 months ago, the fund has not been able to do, and the returns have been quite low, even in the not only in the near term,
Right.
but even in the longer term. So, how do you plan to improve the performance of the scheme going forward?
Yeah, so that's the challenge my seniors have put on to me. So, and this is my personal view of that fund, right? This category of fund is one sold to investors who are the least risk-taking ability, right? They don't want to take the entire risk of investing into equities. Plus, it's like a fixed income plus or a FD plus kind of a product, right? That's how it is sold. But what happens is during good times, people compare returns and with the benchmark of yours, and bad times they say, "Acha kiya." So my understanding of this fund is, as a fund manager, you have to be very stable in your stock selection and sizing. By what I mean is, if today, say a particular stock, X stock, I like it, all my four parameters are very strong, right? I will buy, say, X percentage weight in my equity opportunity and my tax saver fund. However positive I may be in DAF, I will not buy such a high weight. The reason is there comes in the risk. See, to go wrong, anyone can go wrong, right? So I want to reduce the risk over there in terms of sizing. My best weights will not be in my DAF fund. Best names will be there, but the weights will be significantly lower than what they are in equity opportunity and tax saver. One. Two, sometimes you have to balance the portfolio in a different way than you would do in your regular funds. By what I mean is, at the time of euphoria, you try to bring down the beta of the fund. I am not telling you I'm going to give you 30% return every year. So during that, euphoria, you have to be slightly more balanced and think about downside. If something goes wrong, how are you going to protect your downside? So not being on extremes on any value growth style, not being a lot of extremes. And when you're sizing your positions, I mean, think that way. Take your Rohit, you're buying 1% less, you may gain 20 bips less, but that's fine. If you go wrong, you will lose 50 bips less. So I think have a balanced approach in terms of the stock selection and sizing. I hope this approach helps us, and investors have a better experience out of it.
Rohit, another thing was, coming to the Tiger Fund, which you have been managing for a past decade or so.
14 years.
Even though the fund has given good returns, but if we compare to not only your fund but overall of the infrastructure funds, if we look compared to the benchmark, then all have underperformed all the particular funds in this category. So two things. Just wanted to understand what is the reason for the underperformance of the category compared to the benchmark. And secondly, I just wanted to understand, is this fund really suitable for the investors, given their cyclical nature? Thematic funds are really usable to investors?
So Chirag, I would like to differ with this statement, and I'll tell you why. It may be a bias since I'm a fund manager, but I'll give you some data, right? So since inception, this fund has given slightly higher than 18% CAGR returns. For the last 15 years, it's around 15-16%. Last 10 years, 18.5%. It's beaten the NSE 500 hands down, right? When I look at a lot of diversified funds also, it's done better, right? Now, what happens is when you look at the benchmark, right? The benchmark for these funds, the so-called infra manufacturing category of funds, it's again my personal belief, right? It's not a right benchmark. You have few stocks which are 20% weight, 15% weight. I cannot buy more than 10% in my fund, right? As a regulation. So when I look at my Tiger funds returns, like, I'm not talking about 1-2 years, which have been great. When I look at 5 years, 10 years, 15 years, and almost now 20 years since inception, I would not agree. I think if you look at the broader benchmark, which is NSE 500, I think it's done very well, right? Now coming to your second question of, for kind of investors. So since 2010, when I took over the fund, I do remember till now, 3 times we have pitched the fund, right? First 2 times my pitch was buy it tactically over the next 15 months, 18 months. Things are happening, things are changing, stocks should do well, the fund should do well. And think from that bite. The third time when we started pushing the fund, that was in sometime in 2021. I went out and told investors, buy it for 5 years. You will say 21 ka bhi 24 ho gaye, 3 years ho gaye. Today also I'm telling my investors, you look at it from a 5-year point of view. What's changed, right? What's changed? Why that whole thing of 12 months, 15 months to 5 years, right? I mean, no one spoke about infra fund 10 years back and said, 5 saal ke liye invest karo. The whole gamut of businesses have changed. I remember in 2010, 2011, when I took over the fund and when we used to analyze companies, we used to look at order books. what is the order book, what was last year's sales. So what is the order book to sales ratio? Higher the better. We used to do the P&L, we used to do the balance sheet, but we never used to focus upon ROE and cash flows, right? Order book आ जाएगा वही बहुत है, right? Execution, I think we used to hope execution will happen. Execution delay used to happen every year. Today, when I'm talking about my businesses, right, we're talking about ROEs, cash flow generation, what kind of dividend the company will give, what is the net debt to EBITDA, interest coverage ratios. So the gamut of businesses have changed. That time infra was there. We talk about golden corridor that will banega. Today we're talking about refractory businesses. We're talking about abrasives. We're talking about building materials. We're talking about overall general manufacturing, right? So it's make in India, right? I mean, today, I mean, internally, I mean, it's not like probably when I talk to my internal sales colleagues, like what I tell them is the make in India sign is tiger, right? So that today is make in India. But think it's an old fund. The name is tiger, right? And infra comes in it. So people have the perception is infra. When you look at the portfolio of the tiger fund for the last 4 or 5 years, you will say it's a manufacturing fund. If I would just give you the name of the companies and move the name and ask you, which category this fund should be. So I would say that I think it's got a good leeway, this space. I am very confident. And today also someone comes and asks me, I said, you invested for 3 to 5 years. So that's my view on Tiger for you today, Chirag.
Okay. Rohit, another thing was you spoke about the markets and how the things, but which are the sectors or the given the current market scenario, are there any particular sector or industries where you find value currently?
Okay, I find value in banks, right? That goes without saying. So when you want to, now when I add business outlook to it, and maybe value, I'm not as comfortable as in banking sector, but I still feel the sectors are good. One is the entire power chain, right? From power generation to distribution, transmission to power finances and automobile. It includes OEMs and auto ancillaries. So you would ask me, these are the three themes I really like today. Banking, auto OEMs, and the entire power value chain, right from generators to power financiers.
And which are the sectors you are, you feel that there's no value as of now, and you would like to stay away?
So I'm underweight IT, I'm underweight consumer staples and energy, right? So again, over there, the business समझ में नहीं आ रहा. What will change in the business, how the business will grow. So again, see, these are good companies, right? In this space, right? Huge cash generation, huge cash dividend deal, everything is good. But the growth, the first two aspects, right, of my whole thesis, I don't see a reason to own them a lot, right? But again, as a portfolio approach, you have to identify few names among the whole set of this sector, right? Who could do better relatively, right? And own them. So yeah, I would say IT and staples are two sectors I'm underweight and slightly on energy.
Coming to a last question. So, over your long career in investing, what market trend or event has surprised you the most, and how has it influenced your investment approach?
I think there have been so many surprises, right? I mean, I joined in 2000, and I think that time was the Ketan Parekh.com bubble, right? Globally and India, right? So I said, "Kahan join kar liya?" For so many years, I was thinking, this is a good industry for me. And the year I joined, all this happened, right? So what was the learning over there? So when I used to sit with my IT analyst, who was there with us, what happened, right? Using valuations, you were just, trying to just explore things without the basic fundamentals, right? Like as I gave you one example, stock price chal raha hai, so everything is fine. You forget the fundamentals. That was one learning, right? Then you came out of the learning, suddenly slow. Then I think we had the global financial crisis 2008. When again, when you look at international notes, nothing is, everything is dead, right? Whether you going to get back your money also in a bank and all, you don't know that, right? Everything was there. So there again, the learning was extremes. So again, the 2000 experience and 2000, wherever you see some extremes, right? And the base with, again, I'm using this word again, the fundamental core is not in sync with what you're saying. I think you need to be worried about. I think that was two learnings. Then in India specific, I would say demon, right? And it was not a learning over there, it was your behavior, right? So, okay, an event happened. What do you do next day? You take a call ki everything is dead. right? Or can you be slightly aggressive or slightly different and you say, let me identify the good out of the bad or the good out of the worst and let me focus on them, right? Because in these times, I mean, like for COVID, right? Your first impression is sab bech do. Everything is going to die. And everything is going to die, then whatever you're doing is not going to help you anyways, right? So that time, if you just try to sit down and have a second level of thinking, if things have to turn around or move, right? Who will do better? Focus more. I mean, if you would ask me, will crude be negative price at any point of time? कि आपको crude भी मिलेगा, पैसे भी मिलेंगे, right? I mean, so these are the markets become extreme, and in those extremes, if you are able to benefit out of it, so I would say learnings are a lot, mistakes are also a lot, right? But the idea is once you make a mistake and you do some learning, if you can avoid it next time, I think these are the few things. Then every budget, 1 month before the budget, people are blah blah blah. What will happen? What will happen? 1 month after the budget, same things. One after 2 months, what happens is what is the earnings? What is the core? What is maybe come back? So how to avoid noise? And if you have made a mistake or learnings, how do you put them into work and next time you don't do it?
All right, with that, it's time for us to wrap up our chat for today. I'm sure that our viewers will benefit from the insights that you've shared. Rohit, thank you for answering our questions. It's been great having you. Thank you.
Thank you for having me, or thank you so much. Good day.